The Fed today was really a tale of two press conferences. One in the beginning, which was very dovish, and the second one, which kind of was fantasy land about what the Fed would like to do under certain scenarios, and even if those scenarios don't take place, they might just go anyway. So let me go through that with you, and I'll discuss my take on that. So she started off very dovish, talking about the jobs numbers being not so good, as she went into a bit of an explanation as to why they weren't good. A lot of people are part-time. They want full-time, but they're part-time. And I think a lot of that, believe it or not, is because of Obamacare. It has forced a ton of companies to not hire full-time. They're doing part-time. And then there was some other recognition about the labor market, the headline number being overstated. So that is good. You want to hear, I mean, it's not good for the economy and it's terrible for the country, but it's good if you want interest rates to stay lower for longer, which we do. So she also talked about the fear of the strong dollar, which, believe it or not, is potentially one of the biggest risks I see to the equity market and to the global economy. The dollar is already very strong. Obviously, interest rate hikes would exacerbate that strength even further. I heard some people on TV today saying that if the Fed goes, that might be the kind of the top in the dollar, that it might be a sell the news type of a situation. Maybe, but for me, that would be the beginning of an interest rate cycle increase, and that would be very bullish for the dollar. I mean, we're already basically near breakout levels here, so you have to be very careful. It's good that Janet Yellen recognizes that. She talked about core inflation. Their gauge for core inflation was well below the 2% objective. That was around 1% or so. And they said that they expect to reach their inflation target of 2% in a few years. We know from the past, from Fed Minute Notes, leaks, they expect to reach that number by 2018. It's still 2015, so yeah, there could be some, we could reach their target inflation in 2 years or so, but we're not there now. She also discussed the stock market. She didn't call it this, but basically what is known as the wealth effect, meaning people make money in the stock market and then they feel richer and then they spend more money. She hasn't really, I don't know that she's been on record before discussing that. I know Bernanke has, as has Greenspan, and the Fed is always mindful of the stock market. So she talked about the growth rate. She mentioned how they've been wrong. Duh. They've been wrong for a long time. Wronger for longer. Wrong for long. Wrong forever. They've been getting the growth rate completely. It's a joke. They just lowered their GDP estimates for the fourth quarter. They were like, they had raised them to like 2.3%. Then they lowered them to 1.9%. Now they're lowered to 1.4%. That's out of the Atlanta Fed. That is an abortion as far as growth rates go. That's stall speed at best. You have any type of issues in the world that could grow to zero very quickly. We already know that retail has been very weak. That's been evidenced in Macy's, Nordstrom's, and various other retailers. Yes, a lot of that business has gone online. I've seen anywhere from 14 or 15% all the way up to 22% year-over-year increases, but it is still very bad for retail and bricks and mortars. I have done a ton of shopping the last few days. I've been getting 40% off of just about everything. I don't think I'll ever spend full price on anything ever again. That is code for deflation. They said that they see the risks as being balanced for growth. They didn't see anything coming out of the fiscal policy being a drag, as like debt ceiling fights and stuff. They did downplay their concern about foreign issues, like out of China. They said that China has taken a lot of steps, and they think that there's a little less EM risk. Okay, I mean, the dollar has been rising, and the EM has been crashing as commodities have crashed. I'm going to get on that in a minute. That goes toward the Candyland scenario that they were talking about later. One of my buddies was talking about chutes and ladders. We might just see some chutes and ladders. They do that rate hike. So she was also kind of trying to call a bottom in oil, which was a little crazy. She was saying that she doesn't see the negative effect of oil. She said, I think the word she used was diminished in 2016. So maybe she thinks crude is nearing a low. I've discussed that I see the downside risk being 33s to 37s. We got pretty close there. We closed, RTH was a little bit below 40, and then now I think we're back over 40 a little bit. I don't really see 40 as being that significant of a number. 38s, 37s, and then 33s I see as being significant, but 40, whatever, it's a psychological issue. 40 is the new 50, I guess, in this Kardashian type of world. Anyway, so that's the story with that. There was a little bit more. Oh, so here we go. Now we're getting into the fantasy land of the Fed. So they were talking about expectations of inflation potentially impacting inflation itself. So she admitted that inflation is reflexive, meaning deflation, because it's a negative cycle. Lower prices get lower prices, get lower prices, get lower prices. So that to me was a stunning admission. I don't think that was picked up on by everybody. Often a lot of this Fed jargon is not picked up by the public right away, and then the next day, for some reason, the reporters seem to figure it out. So they talked about the strength in auto and housing, that being holding up the economy. But yes, that's true. But that's also contingent upon interest rates being low, getting auto loans. I think that the lengths of the auto loans have been going further and further out, and we'll have to see how that plays out. I'm a little bit concerned in that department too. I could just tell you anecdotally, I have been looking at real estate as an investment. My family's involved in real estate. I grew up in with a real estate background, and I've noticed prices. It always starts in the rate of change. The amount of the price increases started slowing, and I've actually started to see some price decreases in some of the very highfalutin buildings that are being built in Manhattan and Midtown, these like 100-story skyscrapers. Talk about courting disaster, but some of the full floors are now being broken into two. The 57th Street corridor is slightly softening. I think the Chinese and the Russians are pulling back a little bit, partially due to some capital constraints. I don't want to get too much off into that, but I will say that I am seeing a little bit of issues there. I may take a trip to Miami in a few weeks. If I do that, I will survey that market. I remember I was in Miami looking at new construction in 2007 with a hard hat in what became the Mondrian project, which failed and eventually went bankrupt. A lot of people lost their money, and that eventually became a hotel. I remember saying to myself that it was not one that I wanted to be invested in. I didn't like their plan. For various reasons, this isn't related to the broadcast, but they were mixing floors with residents and hotel guests, which I didn't like. I think the Gansevoort did it better, believe it or not. If you're looking to buy and you want in a hotel, I like the Gansevoort over that one, but that's a whole other story. Anyway, that's neither here nor there. This is what really got crazy. The Fed talked about preemptively raising interest. This is where it gets scary. This is scary time. The Fed talked about presented the case of wanting to raise interest rates to curb potential future inflation, theoretical. They were talking about theoretical models and theoretical interest rates of 3.5%, which, by the way, was my end target rate for them, so that's all okay. But I understand that they want to talk about theoretical models, and they want to let their Fed staff think tank come up with these antithetical ways of getting to normalized, albeit a lower normalized interest rate. Usually it tops out around 5 or 6%, and I think their goal is to top out around 3.5%. So why are they bothering with this nonsense? All they need to do is pull up a chart of copper, and they'll know where the growth is in the world is, or the lack thereof, and where true inflation is really deflationary here. Pull up a chart of oil, pull up a chart of steel, pull up a chart of any of the grains, you name it, it's crashing. Very ugly day in regard to commodities today. It started out with a Moody's downgrade of a very large pipeline of Kinder Morgan. I don't want to get too much into that, but there is a lot of problem. There's a lot of pressure on oil. It's coming from Saudi Arabia, continuing to pump. They want to pick up market share and bury some of the, producers in the U.S., as well as, like I said, it's a market share game. This will be good in the longer term for growth in Europe and Asia. Those are all countries that don't have the natural resources the United States has, and that has been a jackboot on the throat of growth for both Europe and Asia. I believe that stubborn energy prices have been responsible for a lot of the world's woes, and now that they are lower, that will help tremendously for growth. That doesn't happen overnight, though. It takes a little bit of time. A lot of those countries, particularly in Europe, have tremendous unemployment problems with a lot of young men, and a lot of those young men could eventually do things that are trouble. So we have to be careful with that. So this, to me, was a little bit nerve-wracking that the Fed was... They also, by the way, didn't know why... She also kind of, in a moment of candor, mentioned that she doesn't know why. She's surprised that the Fed policy hasn't helped boost the economy more. They don't understand why they're still at stall speed after 7 years of rounds and rounds of trillions of dollars in QE. So they thought that the policy would act faster. They... what was this? They talked about this natural real rate, and then the partial recovery. That there's a partial recovery of it. This is the big concern I have. So let's go back now to the economic data that we know for a fact this week. You had a PMI, which was an abortion. It was a contractionary number. You had ISM. That's it. That was also contractionary. These are recession levels of economic data. This is very, very dangerous going forward. It would be really weird for the Fed to hike with contractionary data, considering they keep talking about themselves being data dependent, and they kept on saying that it's not a foregone conclusion, they're data dependent. I guarantee you, no matter what that number is on Friday, the unemployment number, the media will say it's bullish enough for them to hike. That's going to be the commentary and the mantra. So unless that number is like a huge drawdown, just know that that's what's going to be discussed. I will let you know if I think it is strong or not, and that will be the true read. Wow, I can't believe really long day today. I can't believe I didn't remember ISM. Anyway, those numbers are really key. The ones I really do look at are the ISM. Just so you know, if you want to write this down, this is what the Fed is watching. By the way, they want to see ISM, they want to see PMI, they want to see durable goods orders, they want to see GDP estimates, and they want to look at unemployment. Those are the jobs number. Those are the 5 sort of metrics, the inputs to the Fed that they are watching, and then of course the macro one of the dollar. That is those are I guess the 6 keys of the Fed. We can now talk about that. I have my 6 keys to the market being the VIX, the dollar, the bonds, the oil, the China, and then of course the IBB. And now we have the new keys to the Fed, which are the unemployment. I'm going to go back order. The unemployment, the GDP, the PMI, the ISM, and of course the dollar. So let's go through and durable goods orders. So those are the 6 keys. So a lot of those inputs are really junky. The durable goods order, I want to just go back over this again. The durable goods orders were ex-aircraft. There's a bull market in aircraft, but other than that, it would have been either mildly up or even flat. We know ISM, I said, was negative. PMI, it was negative. The GDP was just lowered, and we'll have to see the jobs numbers. So 4 out of those 5, and of course the dollar, which is the exogenous input, 5 of 6 are not going the right way for Fed increases, and yet they're still running their damn mouths about it. I don't understand what the hell they're doing. I've discussed that I think that they want to talk about moral suasion. I think she did mention that she doesn't want an out of control equity market, and I think a lot of the Fed talk is just that tough talk, that they want to jawbone the market down. It's sort of tightening through tough talk, right? It's sort of like fighting terrorism with climate change. That is like what is going on here. It would be catastrophic, in my view, for them to go 1/4 of a point. I don't want to reiterate this. I know that I'm going to get a ton of debate on this on the stream tomorrow. It's just a quarter of a point. What's the big deal? It's not the amount of the rate hike that matters. It's the move from accommodation to tightening. That is a big, big problem. Anyway, let's get off the Fed unless you guys want to, if you have any more questions about that, we can go into that. I feel that, I think we covered it pretty well. If anyone wants just to type in, you could either say more Fed or move on. F the Fed is right. Unfortunately, we have to get the Fed right. The Fed, if you get the Fed wrong, you wind up in a lot of trouble. They have a lot of power. You can see what they've done with raising the prices of equities for a while. So why is the Fed hike dangerous to stocks? So the answer to that is this, is that we've been in an accommodative and QE moment for a while, and they're still kind of doing QE light because they're still reinvesting the runoff. Like if bonds expire, they could buy more. That would actually be a better place to start if they want to start tightening policy, normalizing policy, because what they would really be doing by hiking rates is two moves. One, they would be cutting off the purchase of assets, and they would start selling assets. So if you want to go from A to B here to C, maybe the better point would be to just maybe first stop buying, or the reinvestment, the runoff. They've been keeping the pool full. Maybe they should just let it gradually, through evaporation, come down first before they start hiking rates. That to me would make more sense. I mean, I guess I'm not a Fed governor. I'm not in the ivory tower. I don't have that infinite wisdom with theoretical models and staff interns running my models there that get leaked, and then they deny it, and then the numbers turn out to be completely correct. Whatever. All right, so that's the Fed. My thesis here, and I've been saying this for a while, is that they need to stay lower for longer. I don't see the growth here. If anything, we are in a bit of a contraction. I have two surveys I asked. I wrote those numbers down. Let's see if I could find them. I often have a lot of pads going here. Anyway, regardless, the numbers were basically, here it is. So I did two surveys. Here are the results. I asked if the economy was in recession, or the U.S. economy was already in recession. 42% of the people who responded said yes, 46% said no, 12% were unsure. We're not necessarily in recession. I do believe we're in a slowdown. We are dangerously close to a recession, though, according to the numbers. But the fact that 42% of people still think that we are, and that 12% are unsure, is bad. Let's go back to meaning the economy is weak. Let's go to the question of whether the Fed will hike interest rates. I just put that question out today. It got a lot of responses, though. I'll be curious to see where that goes. 49% of the people seem to think yes, 43% no, and 8% unsure. Hardly a quorum there. Usually the Fed wants to be in a huge agreement to yes. There is still a lot of holdout no's here. I have to tell you, if you told me the data and what the Fed should do here, I would tell you that they not only should not be talking about interest rate hikes, they should be talking about doing more QE to stimulate growth in the economy. You have a goal of a 2% inflation target. You're running about half of that. You don't expect to reach that until 2018. You have a growth model that was just lowered. That's a recipe for deflation and huge shock risk. God knows if there's a terror attack here, or if there's some type of a shock out of Asia again. I mean, what are the Fed going to do? I heard someone the other day said the Fed should raise interest rates here so that they can lower them again in 2016. They are totally morons for saying something like that. These people, I don't know how they get on TV. It's just ridiculous. But I believe, like I said, I believe the Fed should stay lower for longer. Now we get to the fantasy land, the candy land of the Fed. Does that mean they'll stay lower for longer? The answer is they should. Will they? I don't know. They could do something very stupid, and they could raise interest rates into a slowdown, and they could trigger another recession. I believe that is what will happen, and that is the danger if they do go. I didn't say that I believe they'll go, but I do believe that if they do go, that there is a huge risk of a recession. So we'll just leave it there. So let's get into the 6 keys of the market. I think we covered the Fed ad infinitum. Let's go in. Let's start with the VIX. So the VIX is still... I'm just reading some of the comments. What's 3 months? Yeah, exactly. They should just wait. We know retail is crappy here. They should just wait to see what the Q4 GDP is. We've had 2 years in a row with stall speed and even potential negative first quarters. I think they should wait until March. If they can see if they see things pick up by March, then fine, they will have my stamp of approval to go. If things are still slow by March, by the summer they should be doing more QE. That would be my policy if I was on the Fed. I would say let's wait till March. If the fourth quarter turns out good, we have a good first quarter, let's go. If not, let's either hold or maybe even do a little bit more QE. That's really what they should be doing. What they will do, I don't know. I do believe, though, that they should stay slower for longer. That would be the correct policy. If they go, it's a policy error. Let's leave it at that. Let's jump. VIX, it is sort of toward the lower end of the range. You've got to play directionally here with options here. I would not really be selling premium, and with a few exceptions. Notable exceptions that I have discussed on the stream for the purposes of this broadcast. I don't want to get into that right now. So I think that with all of the bluster today, the VIX did not close on the high. It is still below the 200 MA. It's still below the real longer-term regression trend line, which I have drawn in. If you follow my videos, I will have that in the weekend update. Just take a look. You'll see what I'm talking about. It is, though, like I said, toward the lower end of the range. If you start getting up to about 1785 or so, 1757, 1785, that should be some resistance. You have the 50 MA around 1745. If you start getting above there, the risk then becomes a move to 20 and 22 and 25. Anything above 25, I think there's crash risk. Down here, it's a little bit iffy. It could just flatline for a while. So the VIX today, I was up, but I view it as a bit of a positive because it still didn't really explode, and it did not close on the lows. It didn't close on the dead highs. That's the VIX. The other big one, is the U.S. dollar, the DX. That had a bit of a topping tail today. It closed below a couple of interesting levels. It's still above 100. It's really, really close to the old all-time high. I'm really pressed to not see it at least test there and probably run stops through it. But the dollar didn't close particularly strong. It closed below the low from 2 days ago. It had a bit of a topping tail. It sort of was in the lower end of the of today's range, which is good actually. So that means that the market sort of may have thought that the Fed was maybe a little bit less hawkish. I've heard some people who think that they were pretty hawkish today. That wasn't my read of it. I think the second half of their press conference was sort of a WTF, and I almost slipped there, but I didn't. And that's really what guided them. There was really like a little bit for everyone here today. I read it really more as dovish. Maybe I'm wrong. Maybe they really were that hawkish. I sort of think Janet Yellen is better than that. She's more competent. I really hope that she does the right thing. She's been doing the right thing so far with regard to policy, but it could have been construed that way. TLT, that is really kind of the ultimate arbiter, right? That is bonds directly. They closed very strongly. They actually, if you look at yesterday, the ISM was so weak that interest rates tanked and bond prices went up, and that ISM, I think, had people thinking that the Fed was going to be lower for longer, as do I. Today was a classic consolidation, very bullish pattern actually. The sort of the doji within the big bar closing up at the upper part of the range. Did we close? I think we closed actually over the candle's high. Yesterday's close was 22.83. Today's close was 22.87. That is good. That's really what you want to see for lower for longer. We did, however, stall at the 200 MA and closed a little bit below there. And the ultimate arbiter was the 2009 crash high. We are still a little bit below there. That's 123.15. If you can get back above there, then I would say that you could maybe keep going up. Anything below there still remains a little bit vulnerable, but today's price action was good. I would say if you're long TLT and you're playing for higher, today's low has got to be your stop. If you get below that, GTFO, really GTFO. So that is my take on TLT. Let's just talk about it. I mean, it's so ugly, the oil. Let's just talk USO for a moment. USO, basically, if this is it, this is going to be the double bottom. That is it's not very confidence inspiring either, because we had a consolidation a little bit high above, and now we're back here, and it looks like it wants to break. 1237 has been the range low. Anything below there to me is really real iffy. If you want to jump quickly to the continuous CL contract, we are not at the lows, which was 37.75. Excuse me. The breakout from the 2009 debacle was 37. The reference low there was 33. I really believe, and I know this is not popular, I believe oil is trying to form some type of a bottom down there. Listen, I could be completely wrong, but I do believe that somewhere in that range we'll probably find the bottom, at least for a little while. I know rig counts have been coming down. They haven't been coming down fast enough. There's a lot of fear about the Iranian oil coming on next year with the Iran deal, and we have a lot of oil. We just are awash in oil. Economic activity has slowed a lot. We have had a lot of benefits here in terms of horizontal drilling and hydraulic fracturing. Oddly, a lot of the jobs the strength in the jobs have come from the oil and gas sector. And now with the commodity in free fall, there's going to be a lot of layoffs in those jobs. And those I do consider high-quality jobs. They're high-paying with benefits. They're basically construction and infrastructure jobs. That is great for the country. What isn't great for the country is people being in part-time jobs for holiday work and waiters and waitresses and bartenders and being in a service industry. That is very troubling trends. Everyone talks about the Great Depression and how it ended with World War II, and that is true. World War II did end the Great Depression, but why it ended is sort of lost. A lot of people like to accredit it to the New Deal. That's actually not true. Many of you probably don't know this, though, but I have a lot of experience in history. I took extensive classes on it. The New Deal was a failure, believe it or not. No textbook will tell you that, but that is the truth. What really got us out of the Depression was the fact that the European manufacturing capacities were bombed out by the Nazis, as the Allies had bombed out the Nazis' manufacturing capacity. Who was left to do the manufacturing? The United States. We don't produce anything anymore, except junky cars that people don't really want. That has been ceded to China and India and Cambodia and Pakistan, believe it or not, has a big manufacturing. So we will not benefit from that again. We do benefit from energy revolutions and technological revolutions, but all of those are structural unemployment problems which lower the amount of jobs of people hiring. Think about it. A factory, it doesn't take as many people anymore, costly, expensive people who need workman's compensation, unemployment insurance, who need Obamacare now, who need new higher salaries. They need computers now, and they need software, and they need robots. This is going to continue. That trend isn't going away. I have been in a couple of big chain restaurants late at night after the movies when everyone else is closed, or if I'm on the road, and some of them are even letting you order. They started with appetizers. They don't have main courses yet, but I was assured by the manager, though, that they would have that soon. You can now order without waiters and waitresses, and that's been the job growth, and that is probably going to come to an end. Probably soon you'll have drones delivering delivering your food. Anyway, sorry to go off on a bit of a tangent there, but that was important. So that's oil. We covered the VIX. We covered the dollar. We covered the bonds. We covered the oil. Let's cover the IBB. Let's cover China quickly. Let's do China. FXI. So you held the channel low a couple days ago. You're got up to a key level. The breakout from the bear flag before was 37.66. Smidgen look above, fail. We are still in the channel, so it hasn't fallen apart yet, but you got to be a little bit careful here with FXI. I really need to see the downtrend break. That actually also coincides with the 50 and 20 MA, so there's probably a little bit of pressure from China. That'll probably beef up even more now with this quote-unquote hawkish Fed. We'll see how that resolves. China to me here is a little bit suspect, but I really wouldn't get a full-on bearish unless I saw that big candle reverse, the 36.80 in the FXI. If that gives, then it's look out below. We might be going down significantly, and then that, of course, would be actually good for scaring the Fed, but not so good for the markets. IBB has been an important key to the markets. That's been a bit of a risk-on, risk-off barometer. We have broken the downtrend, which is good, clear, distinct break. However, I don't know what we're doing here. It looks like it might be trying to form an inverse head and shoulders, which would be real bullish if that resolves higher. But there is a little bit risk lower if it is going to form that inverse head and shoulders. We had a bit of a smidgen look above the neckline here, which I drew in at 341 quarter. Smidgen look above. The back off has been there was a pretty big back off 2 days ago, but we've had some hammers. We've been holding the 20 MA. So let's just use the 20 MA as our guide. Above the 20 MA is sort of neutral. Above the 341 quarter is bullish. Below the 20 MA is a little bit more bearish. We could have a 50 MA retest that had been a lot of resistance. Maybe it'll be some support now. Like I said, I really need to see that neckline break. We're trying to make some higher we've made some higher lows. Now we need to see some higher highs. If that can correct itself, that would be good. I think we could easily float up to the breakdown of the neckline up higher. That is between 356.24, which is a 61.8 Fibonacci retracement to the upside, and then the real break, and also sort of where there were some reference hammers. Let's just say between 356 quarter and 360.57 would be an upside target. After that, I would be looking to either sell or maybe even to test right or right out shorts. Let's keep it that simple. Okay, so that covers the six market keys. On any given day, I just want to caveat, one of those will be the leader, and it's usually the one that's up the most or the one that's down the most. Today, oil was the leader there. That and the strong dollar were the problems. The dollar did correct itself a bit, but the oil was just too weak. You can't have stocks. Listen, I understand everyone's excited about FANG, right? Facebook, Amazon, Netflix, and Google. I will never call it Alphabet. If I ever call it Alphabet, tase me. It is Google. It will always be Google. Anyway, those were. I know that everyone's fascinated with those stocks, but you can't have Exxon down $2 and Chevron tanking and Freeport-McMoRan tanking. You can't have all of these commodity stocks dumping and expect the market to kind of resist forever. I will say this, and I hate to be an I told you so until I like to be an I told you so, which I will be an I told you so. I wrote on the stream today that there was a lot of chasing today, particularly in Netflix. That was just like everyone had to own Netflix today. Yeah, I mean, Jessica Jones is hot stuff, right? But did you really have good trade location today if you were buying it above the all-time high after multiple day run? I mean, yeah, it was some kind of consolidation, but to me, that's a trim and trail point. You know, it's not first buy here. Same thing, Amazon today. I actually was watching that one for a while. I was just kind of waiting for it to go. It was hesitating a little bit. It did get a new high, but it didn't. It's still. I would still say the highs in there are still a little bit poor. It looks consolidating. Sure, these stocks can go higher, but do you want to be the guy that paid the? No one If you bought Amazon today at 684.82, congratulations. No one has ever paid more for Amazon stock than you. Feel good? Does that feel good? I mean, I don't know. I mean, in bull markets with bull stocks, and these are bull stocks, I buy the dips. I don't chase the all-time rips. There is a market for all of these types of things. We are not in 2011 in a trending market where the market is up every day, 30% run. We are in a sideways and a really choppy market. To buy breakouts like that, you really need a trending tape. We don't have that. We have a lot of headline risk, and you have a lot of crap coming out of the Fed, and you have a lot of crap coming out of the 6 keys. You need kind of all the stars to be aligned for that. That's not to say I don't think the stock can go higher. It just means I wouldn't be the one who would pay the exact top. Let's just go through these, right? We're talking these. I'm sorry I started with Amazon and Netflix. Facebook. Listen, I'm bullish on Facebook. I've been bullish on I hated Facebook at the IPO. If anyone really wants to go back, just take a look what I was saying. I didn't like it. It got down to $20. That's where I flipped. It got 19. I was a little bit early, and I've never really looked back. I've been bullish on Facebook since then. I've been saying it's going to go to 100 for a long time. It got 110. Actually, I had been talking about 109.28 being the 1.618 fib extension. I got 110.65. It is now a lot of that run happened on Google earnings. It happened twice like this. The last time it consolidated sideways for a while. One day it looked bearish, the next day it looked bullish, the next day it looked bearish, and so on and so forth. And eventually we got the big drop. That is my concern with this. I will say this. I believe in Mark Zuckerberg. I think he is a very, very smart guy. I think he is maybe the best out there in the biz. He is a visionary. He stole Instagram. He's done a lot of really great initiatives. I don't love that personally, congratulations. I think that him and his wife had a great kid. I think what they're doing for charity is really admirable. I don't like that he is now not focused on Facebook as much. I don't like that there's going to be, basically his paternity leave to me tells me that there is nothing new launching in Facebook while he's out. I don't like that he's focusing on charity and a newborn child. I want him to be focused on Facebook. That's it. He's now a little bit distracted. The stock is taking a bit of a breather. Does that mean Facebook is done and it's bearish and the stock is, it's doomsday? I think this stock can double. I just think it needs a little bit of time to, consolidate. So short term, a little bit cautious. Longer term, bullish, but short term, a little cautious. It had the opportunity to have a good pullback. It only pulled back to 100.47. It really needed to test the 99s. I still think that that's possible. It would be very healthy. I'd actually even like to see it test 93s. But we'll see how that goes. I am a little bit, like I said, short-term cautious, long-term bullish. Doesn't mean that the stock can't go higher and it can't break out. It just means I'm a little bit cautious here. I wouldn't be, the stochastics are rolling over a little bit. I would love to see those underneath the bottom line and then start turning and then maybe look to start buying again. So that is Facebook, and then Google. Google is really, it's really amazing that, Google, I think what has happened in a lot of the woes that have happened in Yahoo and in various other companies, Twitter, is because of Google and Facebook are getting all of the advertising dollars that are out there, and people are still pulling from print and they're putting it online, and these are the two places it's going. It's going to Facebook and to Google, and Google has run a lot. I drew some lines on, if you look on the weekend review, that there's a little bit room higher into the 800s, but then you're really pushing up against some trend resistance, and there's probably going to be a little bit of front running of selling that. As long as it's above the 752.05, the stock is still pretty bullish. Below there would get a little bit more iffy. 20 MA held, so you could just use the if you want to be even closer. That's 762.89. 20 MA is really the key with these type of momentum stocks. So just keep an eye on that. If you're long, 20 MA above 20 MA, all good. Below, maybe hedge, trim, exit, whatever. Let me get into some more of the ones you guys want to talk about. So gold, someone was asking about GLD. All right, so the skinny on GLD is that there was, I think it's 100.4. Let me go back. I got to go back in the Wayback Machine. What was that high? There was 100.44 was sort of the neckline of the breakout. There is a big 61.8 Fibonacci retracement coming up, and that is 96.35. Excuse me. Gold is a very technically driven commodity. I would be looking to buy that for right or right out. If you want to play it with put ratios to get there, excuse me, I'm sorry. That area would be, to me, the place to initiate a right or right out trade. Gold is priced in dollars. As long as dollar is going higher, gold is going to go lower. That's simple. I think it was bought up by a lot of speculators a few years ago. It ran quite a bit. There was potentially some inflation, and gold is sort of constant currency, right? It is the true measure of inflation, and the fact that it's going lower to me means more deflation. I drew in an artificial channel here. The low there could take you down even quite further. Sometimes the 61.8 it presses through. Maybe you see 87s or whatever, but I do believe that there will be some type of a tradable setup coming in soon. Somewhere in that night, but somewhere in that final $10 between 96 and a little bit lower. The big volume node there is 90, so let's say between 96 and 90. I would be looking to buy right or right out, and I'd also be looking to maybe sell some very near-term out of the money puts, particularly if it comes down hard and fast into there and gets a bit of a vol spike. Someone was asking me about, so Exxon. Let's just circle back to that. I had mentioned it before. Just going through these stocks, sort of in trying to stick into the order in which they were asked. I talked about 83 being a key number. I talked about 86 being a key number. We're below there. If you draw a neckline for the breakout from here, it's 75.98, and the 61.8 of the move was 74.53. If we get into that area, I would be looking to do a right or right out play or to sell some out of the money puts. I have some put ratios on playing for a move down to there that will benefit tremendously if we get there. BABA. So BABA last year peaked on Singles Day. To this year, it doesn't look like that was. It peaked a little earlier than Singles Day this year. It had a pretty nasty pullback, a bit of a false breakdown, and now is rallying back up. The stock looks fairly bullish considering the the time of year we're in and such. I'm not convinced necessarily that that we won't see a little lower in BABA, but the pattern, looks all right. Today was you have a slight topping tail in there. I'd really like to see it take out those tweezer highs. So I wouldn't initiate here. If you can get over 86.35 to 86.42, then you'll probably get 89s pretty quickly. And eventually I feel this stock will see 100 again. I don't know what the order of operations are for that, but I think you can probably buy BABA on some dips. I don't know that I would be chasing it all the way up here, unless the best thing BABA I could see doing here would be to go sideways for a while and then take it out, like build up a shelf and then take it out. So let's see how that works. If you want to be long, just make sure it's above this like 82.81 to 80, what was that high? 82.79 to 82.81. If you're above there, I think it's a long. Anything below there to me gets iffy. Let's keep it simple, stupid with that. Anyway, I think I've been going on a bit long enough with regard to this broadcast. It's already we've been going for a while. If you came in late and you want to see it again, or if you just want to see it again because you liked my spiel, you can see it on Justin Pulitzer Trades. That's my YouTube channel. You should definitely subscribe to that channel. You'll get to see my weekend reviews, my Periscope rebroadcasts, as well as special edition videos. You'll also you'll get notifications. It's good. If you're not following me on Twitter, the handle is @JustinPulitzer. If you enjoyed this broadcast, just subscribe and follow me on Periscope, and you'll get notifications when I do new broadcasts. I think you may or may not have to put that on, but it's definitely worthwhile. So we could, I think we'll end it there. Oh, someone just asked about SPY. Let's just end on SPY. Good point. Thanks for the save there. The SPY I see is this. It really needs to hold 210 or higher for higher, and if it gets below 207, then I'm going to start getting a little bearish. I'd be willing to give it a little fudge room to the 200 MA, but really it's 210 plus for bullish, 207 below for bearish. I just want to keep it pretty simple. Keep it simple, stupid. There, you have a reference. Yeah, that to me looks right. So today's range is going to be important tomorrow. Yeah, you stopped at basically the 211, and today it kind of held the 20 MA. So 210 plus bullish, 207 below more bearish. Probably really would get a 50 MA touch at that point if you have a breakdown. Anyhow, that's my story. I'm sticking to it, and I'll see you guys on the stream tomorrow and in my Sunday video. Cheers.